Alright, welcome back everybody to my channel, where you subscribe for weekly content on investing, entrepreneurship, and business. In today's video, we got to talk about something that's very exciting. Bitcoin just hit all-time high. The price recently broke past its previous all-time high and reached a new peak above $117,000 in July 2025. And it's no longer the same Bitcoin of 2020 or even the same Bitcoin of late 2021. Several fundamental shifts in the market and adoption are making this rally more than just another speculative bubble. So in today's video, we're going to cover 3 reasons why Bitcoin keeps going higher. The first reason is the Bitcoin halving. The second is unprecedented institutional adoption. And third, favorable macro factors that may be pushing Bitcoin into a new regime. Let's get into it. The first major factor driving Bitcoin's surge is the Bitcoin halving, which is a pre-programmed event that occurs roughly every 4 years, or after every 210,000 blocks are mined. The Bitcoin halving cuts the reward for mining new Bitcoin in half. So the most recent halving happened in April 2024. Reducing the block reward from 6.25 Bitcoin to 3.125 Bitcoin. This means that the supply of Bitcoin being added to circulation decreases by half. This isn't just some arbitrary change to the protocol. It's designed to control the supply of Bitcoin over time, making it progressively scarcer. Here's the thing. If the demand for Bitcoin stays the same or increases while the supply is decreasing, the price will go up. And historically, every halving event has been followed by a significant bullish trend and a new all-time high. Although the magnitude of these rallies can vary depending on how mature the market is when the halving happens. On each cycle since the first halving in 2012 has pushed Bitcoin to higher highs and established a stronger base for its next run-up. But it's important to remember that the halving itself doesn't automatically cause the price to increase. It's really about what else is happening in the market at the time. For example, the 2020 halving had less of an immediate impact because Bitcoin was already in a bull market. The price rallied slowly but steadily after the halving, but the effects were still there. Now, the 2012 halving was different because it coincided with the first significant period of mass adoption. Like when Coinbase launched in Europe, this allowed the price to explode. As for the 2016 halving, well, the price didn't move much until 2017 when a huge amount of speculative capital entered the space. This led to the infamous 2017 bull market and subsequent crash. However, in 2024, having combined with a few other key factors is helping Bitcoin reach a whole new level of legitimacy and recognition. So the second factor that's powering Bitcoin's latest rally is unprecedented institutional adoption. Maybe the biggest difference between this cycle and the last two is the massive influx of institutional capital flowing into Bitcoin. While retail investors are important and they usually drive the initial hype and interest in Bitcoin, it's the entry of institutions like hedge funds, pension funds, family offices, corporations, and governments that really validates an asset and helps it achieve greater stability and long-term growth. And this is because institutional investors tend to bring a lot more money and research to the table than individual investors. They also have long-term horizons and sophisticated investment strategies that can help weather any short-term storms. And this year, they have been pouring money into Bitcoin through various channels, such as futures, ETFs, direct purchases, and mining. This is not only fueling the current rally, but also setting the stage for future growth. Take spot Bitcoin ETFs, for example. The approval of spot Bitcoin exchange-traded funds by the SEC in the US has been a game-changer. These ETFs allow large institutions and traditional investors to gain exposure to Bitcoin without directly holding or managing the cryptocurrency themselves. In fact, firms like BlackRock and Fidelity have seen billions of dollars in inflows into their Bitcoin ETFs in just a few months. This means that a huge portion of Bitcoin's supply is being absorbed by these ETFs and taken out of the liquid market, which reduces the supply and increases the price. As of July 2025, These spot ETFs held Bitcoins worth about $150.64 billion. This is a staggering amount of capital that would easily move the price if it were dumped. However, since institutions don't do that, it's clear that they intend to hold for the long term. This kind of institutional demand is still growing as more and more traditional players enter the space. For example, we have seen more public companies adding Bitcoin to their balance sheets as a treasury reserve asset, further signaling confidence in its long-term value. Grayscale's digital large-cap fund, for example, recently disclosed a $630 million Bitcoin position, making it one of the largest Bitcoin holders in the world. And this is not surprising, considering that more companies are looking beyond traditional assets to diversify their holdings and hedge against risks. It's not just companies either. We are seeing governments around the world increasing their Bitcoin reserves too, recognizing it as a strategic, long-term asset. For example, El Salvador made history in 2021 by becoming the first country to adopt Bitcoin as legal tender. Other countries like Argentina, Brazil, Panama, and Mexico have expressed interest in following El Salvador's lead, and even central banks are getting in on the action. For example, the Central Bank of Nigeria launched its own digital currency called the Naira in 2021, and other central banks like those in Eastern Caribbean, Bahamas, and Cambodia have launched or are piloting their own CBDCs. This kind of institutional adoption and experimentations with CBDCs shows that Bitcoin is no longer a fringe asset or a risky bet. It's becoming a mainstream asset that even the biggest and most conservative players in the world are taking seriously. This trend is unlikely to reverse because it represents a structural shift, moving Bitcoin from a purely speculative retail asset to an increasingly recognized and adopted institutional-grade reserve asset. The third factor driving Bitcoin's rise is a confluence of favorable macro conditions. The current economic and geopolitical landscape is also playing a crucial role in Bitcoin's appeal. From inflation concerns to geopolitical conflicts, from low interest rates to easy credit, we are living in a unique time that is testing traditional assets and creating opportunities for alternative investments. For example, Bitcoin's perceived value as a store of value and a hedge against inflation has increased due to concerns over global economic uncertainty and rising prices. In fact, some studies have shown that Bitcoin has performed better than gold as an inflation hedge in recent times. And as more people realize this, they may shift their portfolios towards Bitcoin, especially with the recent approval of spot ETFs, which make it easier to access Bitcoin within a traditional brokerage account. Then there are the geopolitical tensions and conflicts that are shaking up the global order and disrupting traditional markets. For example, the war in Ukraine has created a refugee crisis in Europe and sparked an energy crisis in Asia. It has also put pressure on the US dollar, which has declined against the euro in recent months. And this decline is likely to accelerate as the conflict drags on and more sanctions are imposed on Russia. But here's the thing. During times of geopolitical stress, investors tend to flock to safe haven assets like the US dollar, gold, and government bonds. However, this time is different because the US dollar is not a reliable safe haven. Due to the quantitative easing policies and the printing of trillions of dollars to finance the federal government's budget deficit, the value of the US dollar has been diluted significantly. And this dilution is likely to continue unless the government takes action to reduce its spending or increase its revenue. Now, Bitcoin, on the other hand, is not controlled by any government or institution. It is decentralized and resistant to censorship, confiscation, and manipulation. This makes it a more reliable safe haven than the US dollar, especially for investors who are savvy enough to use it. So as geopolitical tensions rise, we may see more investors turn to Bitcoin as a way to protect their wealth and preserve their purchasing power. Finally, we have the potential rate cuts by central banks like the US Federal Reserve that could boost risk appetite and fuel Bitcoin's rally. In fact, some analysts believe that the Fed will cut rates in 2025, which would signal a return to economic normalcy and a boost to risk-on sentiment. This could encourage investors to move their capital into riskier, but potentially more profitable assets like Bitcoin, rather than holding on to safer but lower-yielding assets like bonds or cash. And this brings us to the idea of a tech crypto supercycle. Some analysts argue that Bitcoin is entering a new regime of exponential growth driven by the convergence of two powerful trends: the growth of artificial intelligence, or AI, and the mainstreaming of cryptocurrencies. They believe that the AI revolution will create a massive amount of wealth and innovation, and that cryptocurrencies will be at the forefront of this transformation. They also believe that Bitcoin will benefit from the development of Layer 2 solutions, such as the Lightning Network, which will make it faster, cheaper, and more scalable. So overall, Bitcoin's recent rally is a culmination of multiple powerful forces. Its inherent scarcity mechanism, the unprecedented institutional demand, and the favorable macroeconomic environment. However, it's important to remember that while Bitcoin has historically recovered from any short-term price drops, it's also faced regulatory challenges, security threats, and market crashes in the past. Only time will tell how Bitcoin navigates these challenges in the future. I hope you enjoyed this video. Feel free to share it with someone who might learn something from it. And thank you guys so much for watching, and until next time.